Howdy, Jacob here. Today we're going to do a more in-depth analysis on Concentrix Corporation. This will not be the end-all be-all numbers. This is just I looked through the most recent year and a half's worth of quarterly reports, most recent 10Q and most recent 10K, pulled some notes. But I want to remind everyone about the financials first before going through it, and then remember that everything I say is my opinion. Do what you want with it, and I hope you enjoy the video. All right, so Concentrix Corporation is a customer experience technology firm. They were founded in 2004 and they do customer experience on all ranges of sectors of business, from computers to consultants to banking, etc. Their growth has been very impressive. Just under 2 billion in revenue in 2017 to over 7 billion in 2023. Gross margin, not very impressive, in the mid to upper 30%. Operating margin, single digit, not crazy impressive there. They have a dividend that they can easily afford in relation to earnings per share, and a return on invested capital, not crazy high. They don't have any R&D, so it's not like they're spending a lot of money for future growth and future prospective margins. So it's really just cost of goods sold, sales, general, and admin. Their balance sheet, we did see an enterprise value very high, and that's because they have 4.9 billion in long-term debt and only 295 million cash on hand. Their cash flow statement shows very solid production of free cash flow, well above their capital expenditures. So much so that they just spend a lot on acquisitions, but they can't afford it through their free cash flow, so they go into debt to fund those projects. We see 3 large net acquisitions in the last 7 years, and all were funded at least partially with debt. And so let's go over some of the things I pulled from the most recent 10Q, 10K, and their quarterly reports. So I have their CEO cares most about revenue growth, profit margin, and strong free cash flow. I like the free cash flow. They bring it up every time a business talks about free cash flow. It makes you feel better. Obviously, that's not saying whether they're doing it or not doing it, but just them saying it makes me feel good, because that's one of the biggest things that I care about and want the company to focus on. Profit margin, margin expansion, absolutely that as well. Large recent acquisition of WebHelp for approximately 3.8 billion, which to me is their entire market cap. So that's why they're in their enterprise values is great in market cap, because a lot of it was debt. But that's just crazy to me. Some of the research I did, I wasn't able to find a whole lot, but in 2023, their full year revenue was about $3 billion, and they produced about 500 million in their adjusted EBITDA. So not figures that I really prefer to look at, but from that it looks like it was possibly a reasonably priced purchase. 82% of revenue generated by non-US operations. So their highest revenue geographically is actually the Philippines at 22%. Then you have America 18%, and then followed by India, Canada, and a bunch of other non-United States operations. Their 5 largest clients make up 22% of their revenue, but no single client represents more than 20% of revenue. 13.2% of their shares outstanding of common stock are owned by an affiliate of GBL. So I didn't write the full name because I couldn't pronounce it. But basically just saying that there is a company that owns a good amount of shares, meaning that hopefully, they're if you really want to invest in this company, maybe research them, see if they have a good history of ownership in the past, and they're really going to push. See if they're really involved, trying to make the business as much money as possible, or whether they're just kind of passive there. Interest expense is up big, and again, that's one because debt went up, and then 2, interest rates are up. So in 2021, they only had $23 million worth of interest expense, 70 million in 2022, and 200 million in 2023. I presume it's going to be even larger in 2024 because they have more debt, and if they redid some of the or refinance, some of those interest rates are going to be way higher. Free cash flow allocation looks super wonky. This is because there's 5 things you can do with your cash. You can make acquisitions, reinvest back into yourselves, pay a dividend, buy down debt, and repurchase shares. Obviously, you can stick in cash, whatever, but the use of cash that you can do is really those 5 things. And they went into debt a lot, so they didn't repurchase debt, so that's why it looks weird. And then they acquired net acquisition was massive, and so that's why this looks a little wonky. But 273% of free cash flow went to acquisitions in the last 3 years. 228% negative to debt, meaning they issued 228% of their free cash flow. So if they earned $1 billion in free cash flow, they issued 3.3 billion, just a lot, right? And then 16% to their dividend, 18% to share repurchases. So basically, what this tells me is when I look at the past and I see the revenue growth, it was largely due to leveraging themselves to get that growth. And so I'm definitely going to be dampening down that growth, dampening down those margins in the fact that a lot of their money that's been going to acquisitions and issuing debt is going to be switching that, and not as many acquisitions, and you're going to be using a good amount of capital and that free cash flow to pay down debt. If they don't, then I'm not interested in the company, honestly, at all. So $5 billion in debt, roughly 131 million due in 2024, 768 million in 25, 820 million due in 2026, 1.9 billion in 2027, 800 million in 2028, 550 million thereafter. And their most recent free cash flow was, or their largest was about 500 million. And so they have a good amount of debt in relation to their free cash flow due next year, 2 years from now, 3 years from now. In 2027, 1.9 billion is due. That's a little bit concerning. They don't have the free cash flow and the cash on hand to be able to fund that, so they're going to have to refinance that debt. And so, a company with this much debt, you're definitely going to have to put in your margin of safety, and it will dampen your terminal PE and price free cash flow because, again, if you're basing it off of enterprise value, the enterprise value is going to be quite a bit higher than their market cap because they have a lot of net debt. But for me, like I said, the company's historically grown very impressively, but all of these revenue growths are with immense leverage. And so with just a little bit of money going to acquisitions, maybe 20% of capital to acquisitions, I think they could get 6% a year in growth. I think their margins of 4 to 6% make sense. I think still no share change because although they spend money on share changes, their stock-based compensation is pretty high. And then their P and price free cash flow more so based on enterprise value. I think even with about 40% of their free cash flow allocation going towards debt, they're not going to be. I think their enterprise value is still going to be quite a bit higher, about $3 billion higher, if this is their capital allocation than their market cap. And so with that, I probably want a greater return because, again, the company's got a lot of debt. And I don't know if they haven't historically done some of this capital allocation that I'm putting in here in the past. And so they're going to have to change it up, do some of the things that I think I would be looking for. And if I don't see them do that in the next year or two, I just wouldn't invest because I want the company to be doing at least some of what I want them to be doing. Right now, they're focusing, whatever I said, 20% of capital allocation to share repurchases, 18% to share repurchases, 16% to dividend. But that acquisition and going into debt to fund those is not something that I'm attracted to as a business. And so for me, even with it being 39% from the price, even if it were a screaming deal, you don't just buy something based on the numbers. It has to match your story as well. And so if I did this based on what they've done historically, I'd probably put 10%, maybe 10 on the P and price free cash flow. But again, that's just leveraging for growth. And that's not a business I want to get into, especially with interest rates as high as they are right now. Yes, they might be going down shortly, likely, but it's just not the type of business I want to own, is someone that just goes in debt to fund everything and for growth. And so for me right now, still needs to drop 39% before you get the price I'm looking for here. But again, that's just based on the numbers. It needs to match my story and match what I want in a business. So I do hope you enjoy the video, and I hope you have a fantastic rest of your day. Thank you.